Okay, good evening, everyone. Welcome to another episode of Sequoia Training on a Wednesday night. And if this is the first time that you are with us, Sequoia, it's a commercial lending platform. We welcome everyone onto our platform. And our goal is to disrupt the commercial lending industry. Why are we saying that? Because we realize that commercial lending is a very closed-door industry. A lot of our business people out there have no idea where to get the funding that they need other than go to the bank. However, in reality, there are so many funding sources out there to provide different type of funding solutions for our business owners. As long as the project makes sense, as long as the business makes sense, most likely we have funding source for them. So before we introduce the speaker for tonight, just a few reminder, okay? Today is what? Today is May 8th. May 8th, 7 more days. If you were 1099 back in 2000 and 2021, those 2 years, if you receive any 1099 payment, there is a program out there called SETC, Self-Employed Tax Credit. It is not a loan, it is a government paying back, crediting back you the tax, the self-employed tax that you pay to the government. So for 2020 and 2021, if you were 1099 or receive any type of 1099 income, please do yourself a favor. Please apply for it because May 15th for the 2020 filing is going to expire, meaning that, hey, if you do not apply, that money is gone. It will go back to the government. For 2021, we still have 1 more years to go. Okay, we still have up until May 15th, 2025 to file 2021's tax credit. Yes. Okay. Again, so that is something
other monitor.
There's something that I suggest everybody to go out there to, apply for yourself. All right. So now tonight, what are we going to talk about? It's something that is very, very interesting. For the longest time, I have people come to us looking for equipment loans, working capitals, term loans, so on and so forth. Those are pretty straightforward. As long as they in the business for 2 years, they have tax fundings for the business. However, that type of loan normally takes a while to actually get funded. So for example, like working capital, most likely would go through SBA to get working capital. It takes a long time for SBA to approve that 30, 40, 50,000, whatever that loan might be. So we have a lot of businesses that cannot wait that long. A lot of the businesses where they have contracts with the government, they have contracts with other institutions. They need funding immediately. We also have businesses that is actually purchasing product overseas, bring it into the United States and sell it to a third party. So this type of company, they cannot wait for 60 days, 90 days, and 120 days to get the funding. They need the funding immediately or rather quickly. So we have been out there looking for what type of funding that we can actually tap into. And finally, we found this type of product. So again, I'm not going to ruin the party. I'm going to introduce you to our main speaker tonight, Mr. Mark Demos. He is with Jimmy Capital, and he is here to share with us something very, very interesting. I think that every one of us should pay attention to what he has to say. So Mark, if you're online, the floor is yours.
Okay, thank you. Just first checking, can you hear me?
Yes, sir. We can hear you
great.
well.
Okay, thank you. So first, since Alan kind of gave a little kind of a short introduction, let me give an introduction of myself, and then I'll jump into the kind of the technical meat of the matter here. But first of all, I heard a couple people name that they were from Illinois. My family's from Illinois. I'm kind of a Chicagoan at heart. I actually grew up overseas. I'm a military brat. Born in Japan, lived there for a number of years, then moved to Italy and then Germany. So I grew up actually entirely overseas until I went to college in the U.S. in Illinois at Eastern Illinois, the Mighty Panthers, and then moved around a bit and settled down in San Diego, which is where I am now. And my background, I've been in kind of different, I was in the tech sector and the hardware technology and lasers and optics for a number of years and then got into finance. And so now I'm pretty heavily a finance guy for the last 15 years or so. And so my objective here tonight is to help you and us, of course, help everybody understand what we do, some of the options out there for the particular type of finance that we provide, which is called purchase order finance and invoice finance. Invoice finance can sometimes be called AR finance, could be called receivables finance. So there's all kind, it's called factoring, by the way, the invoice finance is. And so I'll try to go into that and talk a little bit about each of the kind of different varieties we'll provide and try to help you understand it. Trust me, it's not easy the first time you hear it. It's rather confusing, but eventually I hope to have the second go at this with Alan at some point in the future where you can ask more questions, but we'll drive through it tonight and then move forward. So let me start with the first slide here, which, oh, I need to share my screen. Okay.
So,
Okay. Hold on, Alan, sorry. Okay, is that up there, Alan?
yes.
Okay, perfect. Okay. And all right, so let me just move this so I can get it out of my way here. Believe it or not, everybody, we rehearse this, but sometimes when you actually do it, it changes the look. So, okay. So the first thing is typical, you see my bullets there, typical easy transaction. At a high level, we're going to talk about, and when I say easy, what does that mean? And I think we're all familiar with an easy transaction. We work mostly with hard goods, although services can be included, and I'll talk about that at the end. But an easy transaction on a hard good is something that we'll review. What's an easy purchase order finance? What's an easy factoring transaction? What we don't finance, what we do finance, and then how do we fund it? I'll give you some examples, and I hope that helps you kind of understand what we are and who we are, and that the big thing to keep in mind is an easy transaction is never really the case because there's always complications with fraud, performance, delivery issues, and things like that. So I'll go to the next slide here. So invoice finance and PO finance. So here's a normal transaction. A client, one of your customers, one of your clients receives a purchase order from their buyer. Their buyer could be Walmart, it could be a steel company down the road, it could be Costco, it could be a number of entities. And your client is going to receive it and they're going to make the product, they're going to ship it. That's the July 5th date there. The day of or the day after, their accounting department is going to invoice it. And then at the very end, they're going to get paid. The buyer pays the client the final payment. Super simple, super clean. And that's great. But when that happens, sometimes that client needs extra funding. And so they need extra, well, they need funding for buying products sometimes to fill that order, or they want to get paid sooner. And normally these days, large corporations are paying, they're no longer paying in 30 days, which most of us grew up with customers and companies paying each other in 30 days. Now it's something like 60, 90, and in a really rare situations, 120 days. So, so that's kind of a transaction today, and that gives you a sense of where we are today. Now, let's say those dates are valid, and let's say that customer wants to find a way to get paid sooner. And currently what would happen is that transaction, what happens between the shipment and the payment from the buyer is that shipment occurs, and meaning the buyer's department, they receive it at their dock, they confirm it with accounting, they turn in a confirmation to accounts payable approves it, and then they wire the money to the client. That's that yellow star at the very end. And that's without disputes, fraud, partial shipments, etc. So that's this. Now, let's just say that client, same transaction, wants to get paid sooner. Okay. So now you have a client that is selling to Walmart, Costco, Home Depot, your local steel maker, your local tire company. It could be anybody, small, medium, large company. Generally, the buyer has to be large for this to work for us. but your client, the supplier, wants to get paid on July 6th or 7th or 8th rather than waiting for September 15th payment. Okay. And why do they want that? So usually what happens is the supplier has a cash flow or cash priority issue. And sometimes they're growing quickly and they want to get cash sooner to apply it to more inventory, more growth. They may also have other investments they want to make that provide them greater returns. So they'll use those early payments as a way to fund that requirement. But that early payment doesn't come for free. So we'll talk about that here. So anytime you get money sooner rather than later, somebody steps in to provide that. That's called factoring or receivables finance or invoice finance, and there's a fee for that. That early payment right here called factoring or invoice finance. And if your client chooses to get this early payment, one of the things they have to be very aware of is that this factoring agreement or this invoice finance agreement is a contract, it's binding. Oftentimes, depending upon which factoring company you use or receivables finance company you use, they have very stiff cancellation policies. And they stipulate the advance rate, which is between 75 and 90%. I'll explain that in a second. Then they have payment processing time. And there's a lot that happens in these steps in between. So let me go to the next slide. And this is where it starts to get a little hard sometimes if you haven't seen it before. So let's just say your client has now talked to a factoring or invoice finance company, and they say, yep, we agree, we're going to help you get paid sooner. All the way back to that slide where I had the arrow. Actually, I'll click on it here just to show. So all the way, we're going to pay you sooner, right? And that factoring company, the invoice finance company, is not going to pay 100% of the invoice. So if you've invoiced your company, you're the client, and you've invoiced the company $100, they're not going to pay you $100 on July 8th. They're going to pay you, in this example, $85. So they'll pay 85% of the invoice. And then September 15th, whatever, that's roughly 70 days out, they're going to pay you the remaining 15%, assuming your buyer has paid 100% to them. So just to go back a couple slides now. Here's a normal transaction where the customer waits to get paid. They say, I want to get paid sooner. The factoring company talks to them and says, yes, we will work with you to do that. And here they say, here they actually fund. So what the factoring company, the invoice finance company, is doing is they're paying 85%, call it day 1 or day 2, and then the remaining 15% minus fees on day 70. What does your client company gets? They get an early payment. They get 85% of their money today. They pay a fee for it, but they get that money today so they can use it to do other things. And then that factoring company is doing due diligence to make sure that all this is actually happening. So let's take an example of a delivery of hard goods to Home Depot. And they say, well, we sent the sinks to Home Depot. That factoring company, invoice finance company, is not going to just believe them that they sent the sinks to Home Depot. They're going to call Home Depot or email most likely, or look at some electronic data interface, and they're going to see that, yes, in fact, those sinks were delivered to Home Depot, and they will fund that transaction. And that's, in a nutshell, that's kind of what invoice finance, factoring, receivables finance, AR finance, all of those are this example here, okay? And remember that it's a very tight contract that says the person, or the company, I should say, that gets paid for this transaction at the end is not your client, it's the factoring company, it's the finance company, because they've put the money out already. They've put 85% of that money out, and they're saying, we're first in line to get that money, not you, the client. And so they get that money, and then they take it all, they take the 100%, and they, let's say, you know, if your client got 100% of it, they would remit 15% because they already paid 85%. But in actual fact, they remit probably roughly 10, 11, 12% at the end of that transaction, and they pocket the rest. And that's the fee they make for their work. So it's, everybody benefits from that. So that's invoice finance. That's the factoring transaction. And there's kind of in a nutshell what they do. They do much the same thing as an accounting department at the buyer. They confirm and they pay and they take fees. So now let's go to another example, which is purchase order finance, which is a little bit different. And I'm going to go all the way back, actually not that far back. I'll go back a few slides here. If you notice, let's see if I can use if you notice here, I don't know if you can see my red thing. I left a little gap at the beginning here for May, and then a little bit down here for after September. But in May here, if this client receives a PO, they may already have inventory sitting here at that point, right? They may actually have inventory, but now let me jump forward to the slide where we were, and they have PO finance. They receive PO from their buyer, and they say, I would really like to fulfill this order, but I don't have enough inventory to do that. And I don't have the money to do that. I need purchase order finance. So we actually fulfill a need. That's what my company specializes in. We do the receivables finance as well, but we really specialize in PO finance. And we fulfill that need to the left of the leftmost yellow line and star. And the client receives a PO, they talk to us, they say, hey, we really need your financing. If we agree, then we step in, and I'll take you to that step. Here is they need the funding. They can't ship without the product. So they come to us for financing, and Gemini pays for the cost of goods. And that's what the major step there. So we're actually stepping in, and we pay the client company. So let's take the example of the company that's selling to Home Depot or Lowe's or Costco, and they get a big order and they say, oh, we don't have enough money. We can step in and provide them money to buy their cost of goods. So that's not an invoice yet. They haven't even shipped the product yet. It's just they need money to build or supply product. And that building and that supplying is financed by us. So much like an invoice finance company or factoring, we finance it early. Then the client gets the product and makes it. So in this example, they may be either making it in the US or they may be buying it from China, Vietnam, India. They get the product, they ship it to their buyer. On July 6th, they invoice. And then guess what? Guess who gets paid? Again, we have funded the cost of goods. We've paid 50, 60, 70% of that total invoice cost. So we receive, in our contracts, we contractually receive payment from the final buyer. And that's a critical thing to understand. And that's because there's risk. And anytime there's risk, we want to control it by trying to step in and receive money so that the client isn't accidentally funding payroll that day or buying more goods or buying a new car. We basically want to make sure that they understand that that money is kind of, quote, ours. And it is, because we've funded the transaction. So that's a pure purchase order finance transaction. But in reality, what happens is the blending of the two. And that's really gets kind of hairy, but I'll try to explain it. So that's here. So you have a client up here that says, I need funding. Gemini pays the cost of goods because we've agreed that they're a good risk and that they have good buyers, good customers. The client ships it, they invoice it. And then what happens? Instead of the factoring company, the invoice finance company paying the client 85% of the invoice value, they pay Gemini that amount. And then the next day or so, Gemini pays the client a percentage of that. And that is a major difference in the transaction because now you have two parties involved. We, meaning Gemini and the invoice finance company, have what's called an intercreditor agreement that allows us to pay each other as needed and making sure we are first in line for that payment. Okay. And then at the very end, who gets paid? It's not us because we were paid by the factoring company here in July 8th through the 10th. The factoring company receives final payment from the buyer, and they remit the balance to Gemini. Gemini makes sure all their fees are paid, and they pay the client. So that is a full summary of what invoice finance or factoring or receivables finance looks like, and also what purchase order finance looks like. And it's a lot to digest on one call, but I'm going to go into some examples of what we do and don't fund. And then I'm hoping it kind of clears things up a little bit. And then we'll go into Q&A and go from there. So transactions we don't fund typically. And it's kind of funny that I have this, and I added this just earlier this afternoon because Alan called me with something. So normally we don't finance trucking and we don't finance construction. So I would have left it at that, but after Alan called me, I realized, there's always an exception to the rule. And he called me about a government, a builder for the government. And they were wondering, can we finance this transaction? And so I said, well, usually no, but in this case, let's discuss it. So what I learned from Alan is it's a very different transaction than what I expected, much shorter time frame, like maybe 30, 40, 60 days. So we're going to look at it. So that's kind of the reason I'm leaving that up there is we don't usually fund trucking and construction, but let's look at it. Trucking, we generally won't. I can almost guarantee that, but construction, we might look at it. Medical billing is a subspecialty all into itself. We really won't touch that. It's very, very high volume, relatively high risk, and it's just not something we're designed to do. We will not fund transactions with the buyer, or also known as the payor, in other countries. So an example would be you might have a U.S. Supplier selling to Costco Canada, and I'm talking really Costco Canada, not Costco in Seattle with a Canadian delivery. So if it's an entity in Canada, Mexico, Europe, etc., that's the buyer, the end buyer, we will not fund it. The reason for that, just so you all know, is that our banking laws are structured so that we can go after a non-payment in the U.S., but we are not structured as a company to pursue payments that are not provided from other countries. So it's really mostly a legal reason. That it's not because they're bad debtors. I mean, you could have Mercedes-Benz or BMW or Airbus as the payer in France, Germany, UK, and we still would not do the transaction because the risk associated with international trade. We will not typically, and this is again, there's always an exception, but we will typically not fund a transaction where the U.S. entity is not an LLC or S Corp or C Corp. So in other words, if it's just an individual, it's more difficult for us to fund. We typically want them to have their own corporate entity, which would be the LLC or S Corp. Low margin business, we do not like to fund low margin business because frankly, we cost a certain amount of money each month. Let's just say we take 6 points of margin from them. If they have a 12% margin business, we're taking half their margin and leaving very little for them, and it's just not healthy. So we try to stay away from those, and we stay away from long cycle businesses where the payment is over 120 days. Again, services, we generally don't fund. I'll give you some examples of some that we do. So normally we fund hard goods. A bad UCC position, that's I'll leave that for now, but basically the UCC position is basically where you stand in line for getting paid by the company when they're being paid by their buyer. So if we're first in line, we're happy. If we're fourth in line, we're probably not going to finance that transaction. And then if they have excessive debt, we typically won't get involved. So transactions we like, as you can imagine, they're the opposite of what you just saw. Retailers, large, everybody knows these brands: Costco, Total Wine, Walmart, CVS, HEB, grocery stores, fast food chains, quick food chains, hardware, clothing, etc. Those are the retailers that your customers, your clients would be selling to. Also large corporate buyers, United Airlines, I'm just throwing out examples, US military, state government, local government, Caterpillar, universities, etc. We want them to have good margins, typically 35% or higher. Now, I want to be very, very clear that margin, and if you have not studied this, some of you I'm sure have, some have not, I'm highly recommend you understand the difference between margin and markup. So markup is what you're taking for your cost of goods and marking up. So if I have a product that costs me $100 and I mark it up 50%, I'll sell it for $150. But if I want to sell something at a 50% margin, it means I take that sell price and multiply it by 50%. So for that same product at $150, if I want a 50% margin, my cost would have to be 75 and not 100. So just be very diligent in investigating that as you talk to your clients. The products from our side can be made anywhere. We're happy to fund a factory that, when I went all the way back to that slide where we said we're going to finance the transaction and we're going to finance the cost of goods, those cost of goods can come from China, India, Mexico, etc. We are very agnostic on that. In fact, most of what we fund is in China and Southeast Asia, and then a little bit in the US. Product examples of things. Some of these are kind of fun. Back during COVID, we financed the company that made prison pants. We do a lot of cosmetics companies, a lot of sport drinks, snacks, clothing, pet food, etc. You can see all these. And then the payment terms from their buyer can be 30, 60, 90 days. We're pretty flexible there as well. And then how do we fund? Well, what we fund is a cost of good, and we fund it directly to the supplier. So let's take that sink example for somebody who's funding Home Depot. If that sink is made in China, we actually wire money to the factory in China. We are not wiring money, especially if it's a one-on-one relationship between the factory and the client that you have. We are not wiring money to the client. We're wiring it to the factory so the factory can make the sinks and send them to the client, and the client can then send them on to Home Depot or Lowe's. And the reason we do this is, again, that whole risk issue of making sure that the client does not pay for payroll or go buy a new car with our money. We want that money to go to the cost of goods that then gets sent to the US and into the buyer's hands. Let's see. Well, we often take the transaction all the way from payment to the buyer, and we ask for assignment of payment. What that means is your client will have to relinquish control of the final payment. Instead of the final payment going to them, because we've already funded the transaction, it goes to us. And that's sometimes a sticking point. I would not worry about that right now because it's not that critical, but just be aware of that. And I can give you all a checklist later on what we look for. One critical thing with us is your client can exit the relationship with us, our finance relationship, at any time, literally any time, as long as all their notes are paid. And there are a lot of purchase order finance and invoice finance or AR funding companies that require all kinds of hoops to be jumped through to exit a relationship. And that's simply not the way we work. We like to let the client choose. Do they want to work with us again or currently or not? If not, they pay off their note and they're done. They can walk away and no hard feelings. We're happy to do that. And then I already talked about the UCC position. So that's that first in line, fourth in line example. I talked about this, how we fund. Yeah, that's a repeat slide. Sorry about that. And then what kind of dollar amounts we fund here is, and by the way, Alan, let me see here. I'm not following any questions so far. So just kind of yell at me if you see questions pop up. But what we fund is between 75,000 and 21 million in cost of goods. So clearly that would take you from a small company all the way up to a relatively good sized company before we would tap out. And remember, that's the cost of goods. So if it's 75,000 cost of goods and they're selling at 50% margin, which means 2x on their cost side, that would mean they're doing $150,000 just for that transaction. And we would expect them to be doing 4 to 6 or 8 or 10 of those transactions per year. So we can pretty quickly take a company from a small 75K transaction up to several 100K and then up into the millions as needed. We will almost never start in the 2-digit $1 million range for a customer unless we are really comfortable with it. So that's something to keep in mind. Generally, we like to have one, I shouldn't say one or fewer, but one or a few buyers, meaning sometimes we have companies that come to us that say, I need to finance, let's say, some kind of jam or jelly or some kind of product that goes into grocery stores, and I sell to 100 different grocery stores, not Vons, not Jewel, not Albertsons, but 100 different brands of stores. And at that point, we still might be able to help them with the cost of goods, but we will not do the receivables finance because we're not set up to handle that many different relationships. The company must be operating for at least a year, and they cannot be a startup. They do not necessarily need to be profitable. And then our due diligence, kind of give you a sense of what we look for. We look for tax returns, typically 2 years if they've been around that long. We look for financial statements, an income statement, a balance sheet, statement of cash flows for the last year, and then sometimes for the last few months, depending upon the situation. We look for bank statements that will corroborate their statements on purchases that have been made or invoices that have been paid by their buyers. We like to see copies of purchase orders, so we can give you some examples of that. And then we want to see the invoice to their buyer, but also invoices to and from their supplier. So we really double check things to make sure they're telling us something and we're finding that it's in fact true. Our cost of funds. So this is kind of like, imagine you're borrowing money for a house. Purchase order finance is quite expensive compared to home loans, which is the safest lending there is in the world, other than the Fed. Our financing is typically 2 to 3% per month. So that means 24 to 36% per year. And it all depends on the deal. It all depends on who they're buying, who their buyer is, what product they're buying, what the risk level is, et cetera. So keep that in mind. We pay the day that the funds are received, or the next day, meaning when they're finally paid by their buyer, we don't sit on the money for 3 or 4 or 5 days. We turn around and we remit the balance to them basically immediately. And then we're funding the cost of goods, and cost of goods is much smaller typically than the final invoice. Our rate is similar in the sense that we are only charging on the cost of goods, so the amount of money they're spending for us could be similar to invoice finance. So, and then I'm going to go into some examples here, but this is kind of my early close, and then I'll close here in a second with some other after the examples. But any deals you see that look interesting, talk to Alan first. Don't be afraid to discuss deals that may work. We're always happy to discuss them with Alan, and then from there we can kind of decide whether it's worth pursuing. So, okay, at this point, I think it's probably best. I'm going to go through a few examples. I have 3 pages of examples. What I'd suggest, I'll go through the first 3 here, and then if you have if you have questions, put them up on the chat and I'll open my chat page or chat link. And then if not, we can keep going. So the first example is, and these are all fictitious names that are similar to the real names, but Alternative X Health. This is an actual example of a service that we actually finance. And so this company came to us and they do mental health services for the state of California. They needed financing for basically a bridge between the work they were doing, let's call it day one, and getting paid by the state of California day 45. And so we looked at the transactions and the deals, and we looked and thought it was a pretty good risk. They'd already been doing this for a number of years. And so we stepped in and we fund them. I think I'd have to go look. It's actually my client, but we fund them around $300,000 to $400,000 per month. And again, we fund and finance them on day one, and we're paying for their nurses and their administrative care folks in these mental health facilities. They invoice the state and they're paid on day 45. We receive the funds then and pay off the amount that we've loaned to them, and then we remit the balance to them. So that's a service industry. Pretty rare for us to finance services, but I did want to show you that we do it. It's usually with, obviously this is a state entity. We can do it with the federal government as well. So keep that in mind. The second example is another, and I'm throwing these oddballs up because it's good to hear what's unusual, and then I can talk about what's usual. So this government contractor is actually selling to the U.S. government in the U.S., being paid by the U.S. government, the Fed in the U.S. They're a U.S. company, but the actual deliverable is in Iraq, and it's fuel to the American forces in the Middle East, and it's paid direct by the U.S. government. So the product is being kind of made and just not distilled, but refined in Iraq and delivered there, gas and diesel fuel, but we are funding it here. And then the next example there is X Beauty Company. They sell to Target, Amazon, TikTok, Walmart, and they're partially factored. So first, just to see, they sell to some big names. We used to only finance companies that sold to brick and mortar companies, but now we actually help finance companies that sell on Amazon and TikTok and others. They're suppliers in China, and we pay the supplier in China on day one. The client receives the beauty goods on day 45, roughly. They ship them to some direct through Amazon and some to Target and Walmart. And then we get paid by Target and Walmart on roughly day 100 or 120. So that's an example of a hard good that's coming from China and being shipped to the US and sold. So at that point, I can go into more examples, but I'm sure eyes are glossing over, and I'm sure you have questions. If not, I can keep going. But at some point, it's hard to understand unless you've asked questions, or maybe there aren't any questions yet and you'll have them later. But Alan, maybe you can comment.
I got it. Yeah, let me jump in for questions, right? How much do you fund? Do you fund them 100%? Let's say the PO order comes in at $500,000. So do you fund the entire $500,000, or you fund only portion of it?
So let's take that example of 500,000 is the PO from Walmart, and the cost of goods is 250,000. 100% of the cost of goods is 250,000. We will fund 250,000 to the factory. So we will fund 100% of the cost of goods to the factory. And then, of course, we get paid later by Walmart or Costco or whomever. It's the factoring that takes the percentage. We do not, when you're factoring or doing the AR funding, then it's a percentage. But with PO finance, we fund 100% of the cost of goods, which we hope is roughly 50% of the sale price, because that means you have good, healthy margins.
Right. Got it. And another question that I often run into is that the client, do you require them to have done something like this before? Let's say this is a customer that this is the first time that they do PO order. We oftentimes have client come to us saying that, hey, I just won a contract from the government that I'm purchasing some laptop for the government, but this is my first time doing it. Do you fund first time clients?
So it's kind of an interesting question in that if the client has delivered other products, let's say they've been kind of an example. I don't know. I don't think it came from you, but maybe it did. But there was a client that was selling, let's just say, classroom desks to school systems, and then was requested to sell computers. If they've had a history of doing that, we would finance that type of transaction. But if they have not done anything and they come to us and say, we want to finance computers or classroom desks or whatever, if it's a first time transaction, we are less inclined to do it. Now, if they've been around for a number of years and it's a new project within their company, then um, then we might do it. So it's a big maybe on that one, I guess, is what I'd say, which is not unusual. We'd have to know more details.
Right. Yeah. The reason I ask is that it's not right now, but during the COVID time, we have a lot of clients come to us saying that, hey, I have this hospital that is ordering X dollar amount of money of gloves and masks from me, and I can get them from China, but they never done something like this before. And again, that is I've run into a lot of those clients before.
Yes. And that's actually a great example. We had a ton of um, clients that we finance, a lot exactly in that kind of game, so to speak, during COVID. And we are, I guess I'd say, happy that we did not finance a lot of them because there was a lot of fraud going on. We were
Yep.
extremely careful during COVID because there was so much fraud. So, so that's on that side, we would be very careful. If there's a big boom on something, we're more cautious because the fraudsters jump up and jump into the market. So, and then I saw Joseph asked a question on how do you pay the client after the loan is paid. So I think what you're asking is, so let me go back to if it's purchase order finance, and the client borrows $100,000 to make sinks for Home Depot, and then Home Depot pays $200,000 out. We would get the 200,000 from Home Depot. We would subtract the 100,000 and then some fees, and we would remit that same day or the next day the balance to the client. So the client gets paid basically what they're owed almost immediately upon us being paid by Home Depot. So if that does not answer your question, you can send another group chat or yeah, I can try to answer that. And then
My
Yassine,
question is what is the fees usually? So if I'm the client, let's say, and you pay for my purchase order for my raw cost of my material to make the deal happen, how much of the profit roughly is gone in fees? Is it 20%, 10%? What is your
yeah,
company?
that's the 2 to 3% per month. So let's just say that money's only outstanding for a month. They would pay either 2% or 3% of the cost of goods. So if it's $100,000 on the cost of goods, they would pay $2,000 to $3,000 on that, and they would receive at the very end the $200,000 from Home Depot minus the 100,000 we paid for the cost of goods, and then minus the 2 or 3 thousand for that 1 month of financing. If it's 2 months, then it's another $2 or 3 thousand. So that's why time is always critical in this. You want them to be pretty tight on their ability to turn it from an order to an invoice and get paid, because they're paying fees just like we're all paying fees on our houses if we've borrowed money to buy a house.
Okay.
Does that help?
Yeah, so it's based on the terms. Now, what's the longest term on the purchase order financing do you do for the end client to pay it off?
Yeah, so that's a good point. The maximum we want to see is on the payable from the buyer. We want to see maybe 90 days on the terms, because it always ends up being 120 and sometimes 150. We start getting really nervous at 120.
Okay.
And when I say nervous, I don't literally mean that, but we'll start calling more frequently and making sure everything's okay. And, you know, it just gets to be less comfortable for everybody if it goes beyond the normal terms.
All right, and with the crude oil refineries that are stationed overseas, as long as the end buyer who's doing the purchasing companies based out of the United States, you could do that?
In that example, the buyer was, well, the buyer and the seller in a way were the US government. So we were very comfortable with that. If it's a private entity, we would have to look to see, you know, there'd be a lot more transaction history we would have to look at. So the kind of short answer, unfortunately, for a lot of this is we'd have to take a look.
Okay. So I got a client who's been buying and selling crude oil for the past 20 years almost, and he'll send them through different pipelines to different countries, like millions of gallons, jet fuel, and crude oil, things like that. So I was asking.
Yep, yep. And we would look at it. We've actually touched on it very briefly about 4 years ago. There was a Mexican entity that came to us looking for financing, buying US fuel and selling it into Mexico. The problem often there is they're really thin margins, and they have uh, exchange rate risk, meaning, you know, if the peso goes up or down significantly, if it's not insured, there could be significant gain or loss. And of course, on the loss side, that's not good. So we would have to get it insured as well.
Okay.
And then I saw Yassine, if I've pronounced it correctly, is asking about how you get paid. And that is so you need to refer and work with Alan on that. It's Alan's company. And he's the one that will be the kind of the person that we will be working with. And then of course we'll work with you and your clients. So I think unless Alan may want to comment, but that's
Yeah.
from our side.
The compensation is always the comp plan 6.0 that you can refer back to the video training on YouTube. So regardless what we make, as you are the agent that bring in the deal, you will always get either 23% as a referral or 46% as a personal commission. The difference between a referral and a personal commission is that referral, you just throw in the deal. You don't want to do anything. You don't need to go through, you don't follow up, none of those things. Then we have an advisors to help to follow up. So you make the 23%. But if you can jump in and help us to collect the documentation from the client, follow up, so on and so forth, then you'll get the 46%. Now, exactly how much we get, it's all based on the deal. It could be 2 points, 3 points, 4 points, whatever that might be, depending on the size of the deal. So we will let you know once you submit a deal, and when Mark sent us the proposal, he always let us know that, hey, what is the commission is for that particular deal. That is also applied to any other products that on our platform. It could be 1 to 4 unit, it could be mixed, fix and flip, it could be apartment building, so on and so forth. Okay. Mark, back to you.
Yep. So let me just I'm gonna give 2 more examples here, and then we can wrap it up. If you have more questions, it might trigger more questions. But we have a AudioX video company selling to a fictitious University of Michigan. They are selling to a university, but that's not it. And also to Verizon. Their supply of components come from the US. So in this case, because they're buying like 50 different components, we do not fund the factory directly. We actually wire to the client, AudioX, and we fund them directly. Then they buy the hardware and integrate it into these universities and corporate accounts. And then we get paid directly from University of Washington or Michigan, and Lockbox bank account. So that's kind of an example of a US company buying US supplied goods, selling within the US, and we get paid at the end, but we're paying them, meaning the client directly, not the factory. And then Solid Core Wood Doors, actually kind of a friend's company. He buys from Europe. and he sells doors to Home Depot, Lowe's, etc., all these guys plus direct. And we get paid, oops, I keep doing that. We get paid directly from, excuse me, we get paid directly from them out of their account. So there's what's called a lockbox account. You don't need to be familiar with it, but it's basically a way, kind of imagine if you and a child had a bank account and you could control the bank account, even though they could use it most of the time. That lockbox allows us to go in and get the money that's ours when we're paid by the large buyer. That's kind of a short, easy way to imagine a lockbox or a DACA bank account. So let's see another question here. Do all these goods and services need to be insured? No. So we do not require insurance. We do require that the company have insurance, but that's very different. A company blanket umbrella account is usually a few $100s a year, super easy to get, and very, 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 very common. Like, in fact, almost every company in the US should have it. We do not require any kind of product or specific insurance.
Okay. I have a client right here, an example right here. Probably you can help. So recently, there's a lot of solar company that contacted us. They are solar installers, so they need funding to purchase solar panels or EV stations. They got an order from a client that need to install X dollar amount of solar panel or EV stations or a system. So they need funding to purchase something like that. So is that something that you can fund based on?
Yeah, so that's a great question, because it's actually happened several years ago. It's not last year or the year before, but several years ago. It was a friendly company that we knew here in San Diego that was asking for, they said, hey, look, I'm in the solar world and I need solar panels. And it wasn't my deal, but we looked at it and said, okay, well, what does this gain you if we help you buy this? And he said, well, normally I'm buying about a third of a container per job, but if I buy a container full, I'll save, let's just call it 20%, and I'll burn through that. I'll use those panels within 30 or 45 days or something like that. So it was pretty quick math for us to see that, by doing a little bit of financing on our side, we could save them, and then we basically pay for our own financing. So we funded the purchase of a container of solar panels and did that multiple times, and he was able to build his buildings or houses with the solar panels. Now, keep in mind, we always are doing due diligence on everything we finance. So there's no guarantee if we've done a transaction before with someone else that's similar that we will do this one, but that's a good example of one that we did.
Okay, very good. Yeah, we do have a lot of clients like that in that space, so that opens up a lot of door for us too.
Yeah.
Yep. Okay, any other questions, ladies and gentlemen? We have a few more minutes left. Well, again, it's just curious, right? So just understand that you fund overseas companies. When they purchase product overseas, you wire the money overseas. So as a company, how do you guarantee those overseas companies that will produce the product and send it to the client?
So what happens there, that's a good question, because, you might think that's really risky, but we're not funding startups. So we're looking at previous transactions, and there are multiple ways to confirm that these transactions have occurred in the past. So we can go and look at their wire statement, their bank statements. We can go find the companies in China and Vietnam. We have contacts, and we really, we have had, knock on wood, of course, but we've had zero problems with companies from China, Vietnam, India. They always are, almost always are who they say they are. They're delivering those products. They want that business to be good and healthy. And so we've had really good luck finding that they're the legitimate supplier, and we fund them, and we are able to work, do what we need to do there. And there are a couple more questions popping up here. So what is the qualification for this type of financing? The qualification generally is related to transaction and then customer. So again, the client or the customer for us would be somebody that's been in existence for over a year and is doing this type of work already. They cannot be a startup, and they have to have decent margins, typically above 35% margin on their product. I know that's a really short answer, but I kind of, if you have more questions, Benny, I'm happy to take them from Alan maybe in the future offline, and we'll try to answer them. I hope that, and just type your text if you have more
I have a
questions.
question.
Yep.
So what type of companies will you target this type of funding towards? Because there are other companies that scaled their capital as high as in the millions. So what type of companies would you target your advertising to?
We are typically, and the problem is there's so many different ways to do this, but we typically are financing companies that are selling to the big box stores. You know, all the big stores that you and I are all familiar with driving around the US, the Costco's, Home Depot's, Walmart's, Kohl's, grocery stores, any of those. With that said, if the company that your client is selling to is a big enough company to warrant the risk of us financing it, we will look at it. So I am cautious. I hate to say no to a deal because we like to see a variety of deals. And if they have a good buyer and they're making a good product, we're probably going to be, you know, if their margins are healthy, we will step up and probably help finance that transaction. I'm not sure if I answered your question, and my apologies if I'm being vague, by the way. I'm not trying to be.
No,
It's just
no, I think I got a segment of what you were trying to convey. I think what it is that if there is a small third party that's already working for a larger corporation, then those you would entertain the small the third party entity. And for an example, the company that you mentioned earlier that were supplying medical supplies to a hospital, that third party company, you know, they qualify all the requirements like having an LLC, S
yes,
corp.
yes,
Yes.
yes.
So how do we find those middlemen or third party companies? I would say, how do we just go out and just scout for them by putting up signs and passing out cars? How do we find those people? I think that's what I was trying to
I think I don't know most large and medium-sized cities. I can't speak for small towns. I haven't lived in one for ages, even though I did for a while, but medium and large cities have networking groups. They're business networking groups. And you can find them on Meetup a lot of times, and then there are other ways to find them, but that's a good place to start in any case. And I think those are areas where you go and, you know, you might find people that are looking for help, and as well as it's almost
Okay.
chance, to be honest. And I
You
know
just
it's a
gotta
horrible thing to say for
you just
business.
gotta spread the net into the ocean, and then you know the main fish you're looking for, you have to kind of just filter those out from the ones that you don't want.
Right, right.
Okay.
It's
Okay.
really difficult is the truth of the matter. I mean, there's some of you might be familiar with Apollo IO, I think it's called. It's an email program that it literally has a database of several million, and it's pretty cheap. And you can filter. It takes a little bit of work to figure it out, but you could focus that on your local area and do things like that. Or if you know buyers, oftentimes the leads come from the buyers that, so let's say that hospital you were mentioning, and the buyer knows that they have a supplier they like, but the supplier is having difficulty getting their stuff financed. The buyer might be helpful in that case. And then sometimes if you know a supplier, if you know a company that makes product locally, anyone that's a manufacturer of goods in your local community might have need for this. They don't always, but some of them might. And so anybody that's making physical product in your community, whether they're making nuts and bolts or chairs or cars or car parts, you know, they may have need.
Uh, Good answer. Thank you so much. Thank you for
And
that.
then Yassine asked, and my apologies if I pronounce any name incorrectly, but who is usually the decision maker to talk to? So for the client, the one that we will be working most closely with and lending money to, that is, if it's a small company, it's 100% going to involve the CEO. If it's a medium-sized company, the CEO will probably touch on it. but it'll be the CFO or somebody on the finance team, almost, or the COO, the Chief Operating Officer. Those are basically it. You're not going to get much lower than that if you're working with, it's usually sole companies that are owned by entrepreneurs or their senior staff.
Provide factoring services for, say, trucking and transport and freight type entities?
I missed the beginning of that question. Can you repeat that?
Do you do factoring for trucking and transport industries, or?
No. So the short answer is no, we do not finance trucking. If you were a supplier to a company making truck parts or something along those lines, definitely we would be interested, but we do not finance trucking. There are probably 1,000, maybe more companies in the US that finance trucking. We
Okay.
would finance hard goods that went into trucks or from trucking companies elsewhere, but yeah, but not
So
trucking
products,
itself.
not services.
Exactly. In that case, yes.
Gotcha, thanks.
Hey,
Okay.
I just wanted to thank you. This is Yassine for saying my name right, and you did a great job. Thank you.
Thank you. I appreciate it. And thank you all for listening. I'm sorry if your eyes glazed over a bit. Oh, wait, we've got another question. I have access to many. Yes. Okay. Okay, I'll let
Okay.
Alan take that one. So
Yep, absolutely. Well, great. Thank you so much for attending another night. So that is what Sequoia it's all about. And again, if this is the first time that you're joining us, hopefully trainings and presentation like this to bring value to your business. And every Wednesday night, we try to talk about different type of product, services and whatnot. So we also have many other trainings throughout the week. So Wednesday night is our main training for the entire company to talk about various different type of product and services. Thursday night, we have trainings in Chinese. Tuesday night, we have training in Spanish. And Friday night, we have another training in English that is hosted by Mo. So he's going to talk about different type of strategies, marketing, so on and so forth. So Monday night, again, is the opportunity night where you can bring in guests who wants to learn about our commercial platform and welcome them onto our, our training. That's on Monday night. So again, throughout the week, we have training pretty much on a nightly basis. So plug into us. If you're not yet our member, please plug into us, join our members, join our Facebook page, connect us on our YouTube channel. All the training like this, we record it, we put onto YouTube. So again, it's open to public. So without further ado, well, thank you so much one more time for Mark for onto our platform, and definitely we'll be doing business with you. And for everyone else, I see you Friday night. Good night, everyone.
thanks, Alan.
Bye-bye.
Hi, Alan. Thanks.
Thanks, Alan.
Good night.
Thanks, Alan.